the low end range of that buy sign and balance sell sign efficiency. This sets the tone if narrative is considered, and we've already established that early on that we were looking for lower prices. So that means we can use the midpoint or the low or the lower quadrant. Notice there's 3 specific levels there, not a zone, very specific price levels. Midpoint, well, what's the midpoint of an inversion fair value gap? The same thing that we would call the middle of a fair value gap. The same thing we would call the middle of a wick or a tail, consequent encroachment. So we see the daily inversion fair value gap, consequent encroachment, is right there. Notice we have this inefficiency here, which is what? Daily fair value gap, SIBI. So anyone else watching my videos, if they don't really go through the process of doing this or learning or take good notes, they're going to assume that the market's going to go all the way back up to here because they'll say this is a liquidity void and the market's going to want to have to go up there. Not when it's like this. Like what? We have a higher time frame monthly fair value gap. We went up and repriced to it. We went up to it one more time, halfway, consequent encroachment. And we also rebalanced this area here because we went up into repricing it and then we left the range there. So now this is a balanced price range. And we have 1, 2 premium arrays supporting what? Lower prices. So as soon as we pierce through this low here, this level here, not that very candle, this low of the inversion fair value gap. We don't know it's an inversion fair value gap until price does this pass through. Then we can anticipate the market likely to reach up into the midpoint between this candle's low and this candle's high, and that midpoint is daily inversion fair value gap, consequent encroachment. So the midpoint between this level here and this level there. We trade up to here, trade lower, and close there. Next candle, we open, trade up one more time, trading above the previous day's high, trading up into consequent encroachment of the inversion fair value gap. And what is this candle here? This big, beefy candle. This is for the folks that like to say my order blocks are engulfing candles. That has nothing to do with it. This candle here is the bearish order block. Notice this candle does not pierce or engulf this previous candle. Whoops, there goes that logic. So it's the change in the state of delivery, which is the opening price here. As soon as that opening price is pierced to the downside right there on that candle, this becomes a bearish order block. Now, because this is an order block, we can take that range from the low to the high. Halfway point of that is what? Consequent encroachment? No. Mean threshold. So we extend that to the future, and it would be in this area here. But we have what? What do we have here? We have this inefficiency from this candle's low, this candle's high. Would we reasonably expect, if we have the inversion fair value gap, consequent encroachment, which is half of this buy sign and balance sell sign efficiency, the midpoint of that, if we have that, and we have the opening of this bearish order block, and potential institutional order flow entry drill, we're expecting lower prices, and we have an inversion fair value gap. Can it go back up to the inversion fair value gap high? Yes. The chances of it doing that are slim. By far and large, many times you're going to see that inversion fair value gaps, given this type of movement where we've moved up 5 months one direction, we hit a premium array. There's no reason really to go up to the high of the breaker, and because the breaker is essentially a pattern that you want to trade the low or mean threshold of. You don't want to see it trade the high end. If it does, it becomes a little less likely. Doesn't mean it can't go there. It just means that I don't like to see that. And if it does that and I'm in a trade, I will scale something off to remove the measure of risk that I'm holding if I see it trading to the high of the breaker. Because if it trades the high of the breaker, it means that it's not as bearish as I want it to be. And you don't want to see it trade up there. If it's bearish, it shouldn't get all the way up there. Same aspect that's being shown here. If we have this SIBI from this candle's low and this candle's high, and we had this one big candle trade down like that, do we really want to see it trade above the daily inversion fair value gap high? No, we don't want to see that. Just like we wouldn't want to see it trade on the monthly bearish breaker high. Because if it's bearish, we want to see premium arrays not be reached to. Let me say that again. If we're bearish, if we see premium arrays in our PD array matrix, in the fractal that we're studying in price action, that means all the data that's being shown here. If we can clearly identify where specific liquidity resides or where a premium PD array is in price, if we're really, really bearish, we do not want to see premium arrays traded to. We want to see discount arrays draw price to it. And everything smash through down close candles. Because what is that telling us? Order flow is bearish. Did I have to show you a DOM for that, a depth of market? Did I have to show you a VWAP? Did you have to see a point of control? How about a volume profile? Did you have to look at volume for that? No. Everything is in the candlestick. Everything. You just need to know what it is you're looking at by time. So we also have the weekly premium wick consequent encouragement, which was being respected. Look at the bodies right there. See that? Did any of the bodies cross over that? Nope. But we did have wicks go through it. And that also teaches you what? By annotating your chart like this and seeing how the lower time frames go through it just a little bit. But when it does that, and if you're bearish, you're going to start to condition yourself and say, okay, this is acceptable. And this is why I say this is permissible in price action, where you might get scared out of it, or you might put your stop loss just above that, thinking that it's enough. It's not enough. But I'm not scared or changing my opinion about where the market's going to go, because there might be a small little mohawk, little deviation outside of the levels I'm looking for. This is all normal coloring outside the lines. Okay. This algorithm is my baby. It's my child. So when I look at price action and it colors outside the lines, I'm still going to take this chart and hang it on my refrigerator, hang it on my desk. Okay. It's something my child has done. And I know that this is my child's fingerprints. So I don't worry about these things when I'm looking at it. And I'm not judgmental of what price did in these areas when it's normal to see that very thing. And you won't grow anxious when you're studying price and it's behaving this way, because it's something that you expect and it's likely to occur. Where everyone else might get scared or stopped out, or they may even change their opinion about where they think the market's going to go because the market creates these little wicks. At the time watching it, this is a full-blown bullish green candle. At the highest high of that, when it touches the candle low there, real time, I'm expecting it to just bump just above it a little bit and then recede back into the range. When you start doing these types of annotations, it conditions you to anticipate that very thing. So when you are watching real-time price action or tape reading, you will have that in your mind because you've seen many examples of it. And then when you start getting real comfortable with it and it happens to do that very thing, it feels really good. It's a confidence builder. It's not an overconfidence creator. It's a confidence builder. And it builds this understanding about price action that you would never otherwise get unless you were actually doing these types of things and recording it and showing snapshots over time, not just, I did it for 2 weeks ICT, I'm done backtesting. No, you're not. And journaling is something you're going to do the rest of your career. You want to be able to annotate and log everything. And the more you pour into this part of it, the better you're going to be. So we wouldn't want to see this area up here in this SIBI be traded to. We don't want to see that, because above the daily inversion fair value gap high, we have this separation from this candle's low and the high, which is this candlestick low. That's the inversion fair value gap high. And right away, if this is one of the first times you ever watched one of my videos, this isn't where you start. Okay, this is for people that have been with me for a while and they just want to know how to journal. So before you even get to this part, you got to watch some videos. Okay, there's a lot of things you need to look at. And then if this is the first time you watch the video, watch my 2022 mentorship, 41 videos. Okay, just watch that one and it'll give you some context. But then the market opens here on Wednesday. We open, rally up, and then crush the sell side liquidity, and we go below the low, the daily inversion fair value gap. That makes this low a real low of the inversion fair value gap. The market trades the next day on Thursday. It opens, rallies up, touches the low of this candle here, which is what? That's your bearish order block. It can trade to that level and up to the opening price. Can it just stop and dead in its tracks? Yeah. But what do we allow for? Coloring outside the lines. So that opening price extended forward, what are we seeing right here? The same element of price delivery that's going on right there. This is a mohawk. This is a mohawk. It's absolutely permissible. Why? Because the market dynamics and the underpinnings of the marketplace is it's wanting to go lower. So it's willing to go lower, likely to go lower. Anytime it goes to a premium array that does touch, it does deliver to, anticipate a little bit of coloring outside the lines and not freak out thinking it's going to give way, which is the reason why I have a rule of 3 PD arrays. One, the first one, it can do this and then that's all there is. It can do this and then trade into the second PD array that I would be viewing as a defense. But if I have 3 PD arrays, if I'm bearish, if it trades through 3 PD arrays, I'm probably wrong. And if I haven't been stopped out, I'm going to take the trade off and remove myself from risk. Many times, and you watched me recently trade a live trade in the NQ or NASDAQ, real futures contract, not a demo. You can see that over there on my Twitter account. I was in a trade and I had 1 PD array of the 3 breached, and it was approaching the second one. And my third one was so close and right above my second PD array that if it went to my second one, I was going to collapse the trade entirely and remove myself from risk. So it's a matter of knowing all these things that you just can't get from an ICT video one time. There's no way to compress and put all this bandwidth into one single individual presentation. Not and have the precision that you see me sharing and what my students are able to utilize when they're trading. So this area up here becomes what? Between the daily inversion fair value gap high, which is this candle's low, to this candle's low here, that makes this what? A breakaway gap. Ooh, it's not annotated. Right, it's for you to go in and dig into it. So we see it trade up into the bearish order block, opening price, and trades above this candle's high right there on Friday, which is a institutional order flow entry drill. What is that? It is a entry taken that would be inside of a imbalance like a fair value gap. What is this? It's a fair value gap. It's shaded. It's a daily fair value gap. What kind? SIBI. That means it's a down candle that delivers the fair value gap. Just the opposite of what a BISI is, okay? BISI is a fair value gap that has an up close candle. SIBI, the way you remember easy is, SIBI is sell side delivery, sell off. BISI, buy side delivery, buy up. Okay, that's the way you can remember it. We don't want to see this area traded to because why? We have this high here that it could trade to and create a turtle soup. Trade up above it and reject and go lower, which is what it did. But how far can it go above that high, CT? The opening price here, this is your bearish order block. That's your change in the state of delivery right there. And it can go up to that area there and go through it just a little bit, which is permissible price action. Coloring outside the lines. And then we see delivery aggressive throughout the day and going lower, taking out Thursday's low, digging deeper into this buy side imbalance inefficiency right there, and it's a daily based PD array. The next one is the weekly bullish order block propulsion block. You can see now that we're on a daily chart, it didn't quite get there yet. That would be my next assumption for if it goes lower, and then obviously the entire closure and delivery back to this candle's high. It doesn't need to do that. We've done enough trading into this buy side imbalance, sell side inefficiency. The close here is real close to consequent encroachment, which is not annotated here. But I want you to annotate that on your charts and look at them in lower time frames on the Thursday's price action and Friday of last week. Now, with all that said, the annotations I have over here is that the NQ continuous daily contract delivered the lower prices I expected from the monthly fair value gap SIBI. The weekly profile, now when I say profile, I do not use market profile. I do not use volume turned sideways plotted on my charts. I don't do that. Okay. I don't use depth of market. I don't use VWAP. I don't use any of that kind of stuff. To me, they're gimmicks. If you believe in them, that's your religion. I ain't going to knock you for your religion. But it has nothing to do with why price goes up or down. Weekly profiles, to me, are like templates. What is the roadmap that price is likely to follow? This weekly profile was an obvious Monday high of the week bearish profile that formed immediately after the daily fair value gap SIBI was redelivered to on the Monday price action. That means here's Monday's price action here. We opened, traded down, rallied up to the high, which is the low of this candle. This is that SIBI, the fair value gap SIBI. It goes up here, delivers it to on Monday, and stops trading right there. Then on Tuesday, we open, trade up a little bit, and then slam lower. The weekly profile was an obvious Monday high of the week bearish profile that formed immediately after the daily fair value gap SIBI was redelivered to on the Monday price action. See what language I'm using there? The weekly profile was an obvious Monday high of the week. Now, I knew the likelihood of it forming on Monday's high, but you may not have. But in your annotations, you want to record it like you were anticipating it. Going further, Wednesday proved my bearish bias on the week was absolutely correct by creating a lower gap opening. That's this here. We opened here, traded up, we gapped from the previous day. We gapped, and then a large range candle lower. This led to an amazing large range down close day for NQ. The daily range on the Wednesday extended past the inversion fair value gap low, which telegraphed the high probability of repricing to the inversion fair value gap consequent encroachment before repricing lower on Friday's price action. That's saying this candle went below this candle's high, which is this inefficiency. So this inefficiency was a fair value gap. We went through it here. That makes this potentially a inversion fair value gap, meaning that it has a lot of probability that it's going to go up to the midpoint of it. Why shouldn't it go to the high? I just spent time talking about it. This area up here, we want to see that stay open as a fair value gap. No, as a breakaway gap. And then Friday, we see it open, trades up in here, and then slams it back down. Friday was an easy short selling day with the bearish institutional order flow entry drill and bearish order block inside of the inversion fair value gap and using the inversion fair value gap consequent encroachment as the ideal premium PD array to expect the high of the day to form on. Now, this is again recording it on the context of disrespecting the fact that it's non-farm payroll Friday. Somewhere in here, you want to record that this was non-farm payroll Friday, that you wouldn't be trading that day necessarily as a new student, but you can still see and appreciate the price action and delivery of that occurring. Moving on to the NASDAQ 4-hour, you can see again all the annotations that were on the monthly, the weekly, and now the daily. See the daily fair value gap SIBI, daily inversion fair value gap high, daily inversion fair value gap consequent encroachment, and daily inversion fair value gap low, daily institutional order flow entry drill, daily bearish order block, daily fair value gap SIBI, and now we have elements inside of the 4-hour chart like we see here. The 4-hour bearish order block right here. Change in the state of deliveries there. Market opens on this 4-hour chart, trades up. What's it doing? It's trading just above that candlestick's opening price. This is permissible price action. This is a mohawk. Okay, it's just a little bit outside the lines. That's absolutely permissible. The market trades there, lower, opens here and moves lower again. This area in here is indicating that inside of this daily fair value gap SIBI, there's a little bit more detail as to why we would not reasonably expect the daily chart to see price action go above that daily inversion fair value gap high. Why? Look closer. From this candlestick's low to this candlestick's high, that is your daily fair value gap SIBI. This is the daily inversion fair value gap high, the midpoint of that inversion fair value gap, which is consequent encroachment, and the low of the daily inversion fair value gap low. So here's consequent encroachment. Why did we not expect it to trade up into this area here? On the daily, it was showing one single pass. But on a 4-hour chart, you can see it went down. And then the next candle, we opened and went back up there again, and then down. Down. Delivery in here as well. So what is happening here? Went lower, 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 back up, lower. So this is what? Balanced. So this is a balanced price range. So what do we have from the daily inversion fair value gap high to the daily inversion fair value gap consequent encroachment? We have a balanced price range. Nailing the bearish order block opening price, coupling it with a confluence of the daily inversion fair value gap consequent encroachment of that gap on the daily chart that we saw trade through it here, and then we expect the midpoint of that to act as what? The high on Friday. It's not likely to go all the way through all this just to get back up into a little area here. Let me go back up to the daily chart. Think about this little area right here. Okay, now I'm going to show you that on a daily chart. That's this little area right there. Go on your own charts and you'll see what I'm talking about. This little area here is not likely to see all that trade back up to. This is going to stay open. Why? Because on the 4-hour chart, this is all balanced back and forth price action. So there's no inefficiency. There's no liquidity that's necessary to trade to. So when we trade down through the daily inversion fair value gap low here, our attention goes to the daily inversion fair value gap consequent encroachment, and the likelihood of that becoming, or just a little bit above it, like we see here, creating the Friday high. And we trade up, small little mohawk above the bearish order block, opening price, which is a change in state of delivery, just a little bit above the daily inversion fair value gap consequent encroachment here, and then we see what? Non-farm payroll rip through it and then attack the low here. There. Digging into that daily fair value gap, buy side and balance, sell side inefficiency. Now notice in here also we have this down move here. In the next candle we open, and when the candle opened here, this wick hadn't formed yet. So between this candlestick's low and where we opened, this candle was just one single pass down, which would be looking much like a what? Fair value gap SIBI. But this candle does what? Immediately trades up, hits the low and goes just a little bit past it. What is that? It's permissible price action. And trades lower. That is my immediate rebalance. When it does that, whenever it does that, and you have a bias that's bullish or bearish, in this case, it immediately rebalanced here. That is one of the strongest algorithmic signatures you're going to ever see in price action. I'll have much more to talk about that in my books, but for here, I'm just reminding you that I've already mentioned it here on my YouTube channel. My long-term students know about this intimately, but this immediate rebalance is one of those things that tells you that this market's going to be extremely bearish and it's going to move fast. And then we see it run off. So we have a 4-hour PD array in the form of an immediate rebalance, and then we have a 4-hour bearish order block. Apart from that, nothing else on the 4-hour chart is anything of importance to me. The annotations here show you that the NQ 4-hour journal entry. The NQ continuous 4-hour contract shows how nicely the weekly premium wick consequent encroachment kept price from rallying higher this week. That's this level here. Okay. Tuesday, bearish order block and gap opening lower was the start of the descent and subsequent sell program. That's this gap here and bearish order block. So it's hitting that and then sells off aggressively as it enters the sell program. The daily fair value gap SIBI can be seen as well balanced in the gray area. That's this area right in here. All of this is well balanced because it's back and forth price action. It's not just one candle. It's back and forth, up and down, which reinforce the probabilities of the daily inversion fair value gap consequent encroachment being Friday's high of the day. And we see that actually occurring here. So it's going to have a real hard time getting through all of this back and forth delivery when on a daily chart, it looks like it's inefficient up here when it's not. So that's the price delivery continuum that I'm referring to. You have to know what your higher time frames are showing you. And then inside of those higher time frames, you get into the details. Because as I'm showing you here, the lower time frames are going to show you a much more refined rendition of price delivery that is not always easily ascertained by looking at the higher time frame. The bias in the long-term draw on liquidity, that's the importance of those higher time frames. But the importance of the lower time frame is refining precision. It's not noise. Okay, and finally moving down into the hourly chart here. This is the last time frame we're going to look at in this presentation because obviously you can see it's it's very easy for me to go on and on and on and make this a very challenging for duration purposes presentation. I know some of you, my well-rounded students, like the really, really long lectures, but I want to keep it as short and as concise as possible, but still hitting the most salient points because I want all of you to be doing these types of things. Because if you don't do it, you're not going to learn how to do it well. So we're looking at the 60-minute chart or hourly chart, and we have all of the reference points. Now, obviously, this looks like an entirely different market now, doesn't it? From the monthly chart, the weekly chart, the daily chart, it doesn't even resemble the same market at all. But yet it is the same market. So we're using that price delivery continuum, working from the higher time frame down, looking at how each individual PD array respects and or is negated. In here, we see that monthly fair value gap SIBI, this is that shaded area here. The monthly breaker high is outside the range of this time frame. The monthly breaker low is outside the time frame of this hourly chart. Okay, so they're there. If we were to scrub down and squeeze or condense this chart vertically, it would be up here higher, and the low of the breaker would be lower than this. So for the purpose of showing the 1 hour chart time frame, the respective PD arrays and what was salient for this time frame, I've zoomed in just to show you this, but you can see this is that daily fair value gap buy side imbalance, sell side inefficiency, and the monthly fair value gap SIBI. So we know the two premium and discount levels, okay? And inside that daily fair value gap SIBI, you can see how it's important that you label your PD arrays. You can't just throw a box or a rectangle in there and assume that you're going to remember what it is and how to use it. So everything has to be organized. Everything has to have its place in all the time frames that you utilize. The weekly premium wick consequent encroachment, the 4 hour bearish order block. Now we have this fair value gap here. Where's the annotation for that? It's coupled with the 4 hour immediate rebalance and 60-minute premium fair value gap SIBI. That's this one right here. What's the candlestick's bodies showing you? Consequent encroachment, half of this gap. But what are the wicks doing? Coloring outside the lines. Just trading just a little bit outside, which is completely reasonable. But what is it touching? The previous daily fair value gap SIBI. That's not random. So I have in my notes, when I'm working with price action, when I'm trading, I have all these levels here just as a list. Just like you see price from 15,840, and then below that you see 15,800, and then below that 15,760. I have every respective PD array that I'm showing you here, just in number format and its annotation label, just on a piece of paper. That's all it is. So I don't need a chart. Like I don't need a chart to trade. I just need a piece of paper and know what time it is. And I can trade off of that. So this 60-minute fair value gap is a convergence with that 4-hour immediate rebalance. What does that mean? This movement right here is this. Let me go back up to the 4-hour chart so that way you know what I'm looking at and what you're being shown. This candle here, opening, rallying up right there. This candle right there, that 4-hour candle. Inside that 4-hour candle is this right here. 1, 2, 3, 4 candles. Because 4 single 60-minute candles is that 4-hour chart. That's that market rallying back up, creating a 4-hour immediate rebalance. Then what does it do? It creates this. How could you use that? Well, if you're looking at an hourly chart, as soon as it does this complete run up and then the body closes down in here, if we open here and rally and touch the top of that fair value gap, or here's the really fun part, if we extend past that fair value gap right in here, right in there, as soon as we trade above that, I could go short there. You can go short there. Ooh, that's delicious, isn't it? Where would your stop need to be? Right above that swing high right there. Why? Because this is a fair value gap. You can't use this one. You can't use the stop rate above that because it's the low of that previous daily fair value gap SIBI. It can touch that. That's reasonable. But this high here, it shouldn't go there. If it's bearish, it shouldn't go there. Why? Because this should act as a breakaway gap. Ooh, that's delicious. Sells off. And now we go back into this balanced price range. You can see again all this back and forth delivery that isn't readily available in terms of looking at it on a daily chart. But now look even closer. If we take this candlestick's low, which is the high of this daily fair value gap SIBI, so this shaded pink area here, that's this candle's low to this candle's high. That's the range, okay? That creates that daily fair value gap SIBI. If we drop a fib on that candle's low and that candle's high, and you add in the 0.75 or the 0.25, whichever direction you're pulling the fib from, the lower quadrant of that daily fair value gap SIBI, that's this shaded area here. Notice what happens also on Friday. Look at the bodies. It's respecting that lower quadrant. Trades up in there. Here's a mohawk right there. Institutional order flow entry drill. Bang. Sell short. Sell side. Relative equal lows. Sell side. Hello. So I want you to know that doing these types of things, it's imperative that you are consistent by doing it. And by annotating your charts and pulling out what's obvious to you after the fact, it will help reassure yourself going forward, looking at that hard right edge, because you'll remember things by associating with them previous memories that you've created by journaling. You're condensing and compressing time in a manner with experience that didn't technically happen, but you're recording it in such a way that it tricks your brain into thinking that you did see it coming. The annotation for the 60-minute chart here is the NQ continuous 60-minute contract presented a really easy Wednesday, 2 o'clock in the morning fair value gap SIBI. That's this candle right there. When the 4-hour posted its immediate rebalance. That's this movement here. NQ can be seen respecting the lower quadrant of the daily fair value gap SIBI on Friday at noon. That's here. That's this level here. It's the lower quadrant of this shaded area. Half of it's here, and then the upper quadrant would be here. Interesting enough that it touches that. And then this one here. Now, I ain't making a big deal about that because the inefficiency wasn't created until that movement. But look, that right there, we'll talk about that in my book. As the bodies of the candles tell the narrative of lower prices into the close. And we have that there. So non-farm payroll takes out the lows here after taking buy side, then sell side. That's what non-farm payroll does. It runs both sides of the marketplace. And I've taught that many times and it delivered again like gangbusters. Hopefully you found this one insightful. I hope you learned something about how you can journal and the benefits of doing so and how it builds an understanding about price actions you can't get by watching videos or reading books or listening to anybody just talk about price. even watching them trade or copying them. You'll never get this type of insight unless you go into your own charts and